First, the news. Indian bonds are going to get included in the JPMorgan bond index.
The big headline is that India is going to get added to the JPMorgan Global Bond Index. Now, this is a big milestone. India was the only large emerging market which was not a part of any emerging market bond index.
Now, what does this mean? It's much like a stock getting included in the Sensex or the nifty. Many funds, called passive funds, simply buy the index stocks so as not to do specific research in each stock. Likewise, a lot of global mutual funds, ETFs, exchange traded funds, and sovereign wealth funds who want to take advantage of relatively higher rates in emerging market bonds just follow three major global bond indexes: the JPMorgan index, the Bloomberg Barclays bond index, and the FTSE Russell index. Now let us stick with the JPMorgan index. The index provider, the company, says India will be included in the GBI EMGD index, which accounts for $213 billion. Indian bonds will be given a weight of 10%, which means over $21 billion can flow into Indian bonds. But the inclusion becomes effective from June 28, 2024, with 1% getting added every month for the next 10 months. So the entire 21 or 22 billion dollars will flow in by April of 2025. However, the other two indexes, Bloomberg Barclays and FTSE Russell index, are also expected to follow JPM and include Indian bonds over the next few months. So bankers say the total flow into India only from passive funds, that is, funds which follow the indexes, could be about $40 billion over the next 12 to 18 months. Separately, there are actively managed funds where the fund managers allocate on their own analysis. These funds may start flowing in right away, dealers say. At the moment, foreign funds in Indian bonds are barely $2 billion, and this could rise to $10 billion even before the JPM clock starts ticking in June next year. So what does this mean for us Indians? First, the Indian government's center and states benefit. They've always been running a deficit, a fiscal deficit, and with this new flow of funds, their borrowing cost goes down. Let's look at some numbers. In the current year, the central government is borrowing 15.4 trillion rupees. Let us assume the same number is the borrowing next year. If $40 billion flow into Indian government bonds, that accounts for 3.3 trillion rupees. That's over 20% of the borrowing. Not surprising, as soon as the JPM news came on Friday, yields on the 10-year Government of India bond fell from 7.14 to 7.08. Now yields will fall more closer to next June. So fiscal deficit is slightly less of a worry going forward. The second beneficiary is the larger Indian economy. Our imports always exceed our exports. But now there is a new inflow that can bridge the gap. So current account deficit is less of a worry because there are capital flows. This is big. The two major deficits, fiscal and current account deficits, will become a smaller problem. This will make Indian macros look good, which can attract even more equity funds. Thirdly, the Indian rupee could get stronger. At least serious depreciation is less likely. But the RBI may not allow too much appreciation since that will make Indian companies uncompetitive. But nevertheless, let's keep that in mind. Fourthly, Indian corporates win in another way. Corporate India always pays 20 to 30 basis points more than the government or the sovereign. So if the yield on the government bonds fall, yield on corporate bonds will also fall, leading to lower cost of capital for Indian companies. This can improve margins and fuel a little more capex. Right now, NBFCs are the biggest borrowers from the bond market, and one can see their shares have risen since the news. Indian banks will also see a gain because by RBI rules, they have to hold at least 23% of their deposits as government bonds. They actually hold more. The mark-to-market value of these bonds will rise, and hence in the current quarter itself, they can show slightly better profits. Fifth, Indian bond markets can get a lot deeper. Besides more deep-pocketed investors entering, the Reserve Bank too has announced some changes in how to value bonds. Together, this can lead to more corporates tapping bond markets, and maybe eventually even infrastructure projects can be financed a little by bond markets. But of course, that's in the long run. More immediately, we mustn't count our chickens too quickly. Right now, the US bond yields are rising, and hence the dollar index is getting stronger. Both these make foreign investors book profit and move out of EMs. They are EM negative. So, right now, we may not see too much by way of bond yields decline or rupee appreciation. But these trends are bound to play out over the next couple of years.